Okay, welcome to our second quarter update for our commercial assets. And the kind of assets that we lump into this segment is really everything from government leases to pure office plays to our medical tenants. So combined, that makes up about 1 million square feet. Within that, we have, it's really chunked in about a third of government, office, and medical. If we start with medical, we go through those assets first. They've performed very well and have been very stable over the past 18 months. Our overall portfolio occupancy in medical has hovered around 94%, really for the past 2 years.
Yeah, I mean, this is a portfolio of, Parsons and Park Lane, which are multi-tenanted deals. We have some single-tenant deals like Roswell Pediatrics that are just a standalone doctor's office. But the doctors and professions there are staying, they're renewing their leases, they're paying escalations. I mean, especially if you look at Park Lane, we're pushing, pretty close to $30 a square foot now.
Yeah.
Which is pretty incredible.
Rents are doing very well.
Yeah.
On those assets. And overall, our rents just in the second quarter compared to the first quarter in medical were up about 5%.
The interesting about medical is that they really need a purpose-built asset. Moving, say, from medical to a medical office to a generic office, you're looking at like building out patient rooms and adding so much extra plumbing and electrical to each of those rooms. It's not really reasonable to do. You're looking at the order of like $200 to $300 a square foot of improvements, versus moving into an existing doctor's office that's already built that way. Yes, you can modernize it, do floor and paint, update the reception, but you don't have to do all the infrastructure upgrades. So that's more like a $30 to $50 a square foot TI package.
Yeah.
So we're seeing that our medical tenants are sticky because it is very difficult to move.
Yeah. We look at overall performance in the medical space. We mentioned our rent revenue is up. Our CAM reimbursements in the second quarter over the first quarter are down a little bit. When we look at the first quarter CAM, a lot of times, in really all cases, we're truing up how the prior year went. And 2024 had a lot of big tax and insurance bumps. So that was passed through to tenants in the first quarter of 2025. So we saw CAM revenue bump up in 2025 Q1. In the second quarter, we're now more just on stable CAM reimbursements, so our CAM revenue came down a little in the second quarter, and overall it resulted in a total revenue picture drop of 3%. Again, rent was up, but CAM was down on the medical segment.
Well, speaking of CAM, the business strategy on not only medical, but really all the offices we bought, frankly, all the commercial buildings we were buying other than really government, because those leases are kind of locked in place. The goal was that the tenants are not paying any kind of reimbursables. The market is that they do pay reimbursables. So how do we go in to a property that has existing leases, let those leases expire, and on renewal, talk to them about including reimbursables? So we're getting probably more moderate rental increases, 3%, 4%, 5% relative to the market, but we're getting these pass-through expenses, which we're capturing much more revenue that way.
Yeah, it's been very helpful on the CAM front. Overall, our total CAM reimbursements on the commercial segment are roughly 29% of operating costs. That's about double where it was from the middle of 2024 when we were at 15%. So we're making good progress on getting these CAM reimbursements into leases and having that as a revenue channel into the business. When we look at our medical overall, a lot of times we bought these deals. Our goal was to really similar to the retail space. It's like, how do we get a good lease in place? How do we get the longest average lease term we can? And then we look to exit those positions. So right now, our WALT on our medical deals is 3.5 years across the portfolio. We've gone through some renewals. We have deals that are in good position. So we are looking at selling a few of these deals as they come up to their 5-year point on the medical side.
Yeah, and specifically on the medical side, we're seeing success or traction when we list the deal is the smaller scale properties that are more single tenant, or that like a Park Lane is 3 different properties. We can take the single tenant asset, peel it off on its own, sell it. Or these deals generally are under $5 million, so they're selling to an individual buyer instead of a syndication group like us. We're seeing that on the market right now, that syndication groups like us and lenders for groups like us are just few and far between. and we're finding a lot more success with individual buyers, like we've done with our Midtown property up in Chattanooga. Sell to an individual owner, they have an individual loan on that, it's usually a $3 to $4 million deal, and that works. So we're looking at the whole portfolio is how do we break it up into chunk size, bite-sized pieces, and break down the portfolio that way.
Yeah, the deals really right now that we're looking at selling on the medical side, the VA clinics that are standalone VA clinics, we've received renewals on those, so we're looking at exiting those deals. We have 2 standalone medical buildings, the Roswell Pediatrics, the Baco buildings that we're looking at exiting. And then also if we can take like Park Lane and sell off 1 building at a time, really copying the business plan and strategy we've used at Midtown to sell individual deals. That's what we're looking to do in the medical space. And again, so medical pricing is really good. On the selling side, on the buying side, we haven't found too many opportunities just because the price per square foot, the price per pound is too high for where we're at right now, especially with what the debt markets are at. So on that front, we're mostly looking at selling those assets right now. When we go into the commercial segment, we say, okay, our other stuff that's purely office and government, that's about 600,000 square feet of space that we have across those 2 tenant types right there. Overall, we're 78% occupied. A lot of our vacancy is tied to some specific deals.
Like the station, for example, right? We're working on redeveloping that whole property, and frankly, it's going to be torn down if we're successful with it. We're working with the neighbor to basically build this master plan on, we're talking about apartments, we're talking about townhomes, we're talking about some retail, maybe even a hotel with the city. And if we do all that, we have to work with all the tenants to relocate them. Yeah. So we don't really want to lease any more space there, invest any more TI dollars, sign any more long-term leases, because it's not going to create any more value for us, because the land is the land.
Yeah, there it would just cost us more money.
Exactly. So we're just looking at like how do we continue to cover our costs there, pay our loan, be in good standing with really everything in consideration, and then contribute to this master development.
Yeah. But overall, office revenue was up 10% from the first quarter, so it's performed well on getting additional revenue. A lot of that is also CAM driven, as we have new leases, we have lease renewals that we're able to add CAM into and drive that forward. So that's been helpful on that front. We're going to go into some scenarios of what this looks like too, but overall on the commercial space, our weighted average lease term is 42 months. So it's a little bit higher than the medical side, and we feel like these are positions where we've taken deals and gotten them to longer leases.
Well, so we took these deals in our office segment, like a Johnson Square, that was barely 70% occupied. We've taken it to well over 90, even pushing 99% at times, and we're holding in the mid 90s. And we kind of have its maximum value right now with the average weighted lease term pushing 4 years, but there's not really an exit market to go into right now. Office is still very soft, especially on the lending front, and banks are still trying to figure out what they do with their vacant office properties. So with the Johnson Square, that's actually performing incredibly well. It's covering its debt. It's making distributions as turnover maintains. It's just there's just not a market to exit into. So we just kind of have to ride out the cycle that we're in. So we kind of did the cycle 1, which was take it from 70% to fully occupied in the mid 90s, and now we're in cycle 2, which is operate and stabilize the property through a market cycle.
Yeah. Johnson Square revenues are up 13% this quarter. It's performed well in that standpoint. Net income is up 50% in the first half of 2025 compared to the first half of 2024. So the asset is doing well. It has the longest weighted average lease term, as you mentioned there. So right now would be the ideal time to sell it. But the debt market and the demand market isn't there right now, so we would not be realizing the full value that we think is there. So this one is where we're saying, okay, we're going to hold this for probably longer than expected, knowing that it is cash flowing, it is performing well, we're seeing revenue gains, but we're not able to sell it right now.
Yeah, I mean, TVTC is really in the exact same situation, right? It's like it's basically full, and it's performing well, and we have a great loan in place, and we just kind of have to ride out the storm until.
Yeah, our TVTC loan, we're at 4.1% through 2029, so it's a good one to be keeping. But on the other standpoint of that, we have our weighted average lease term. The longest was earlier; it was 12 months ago. So we're kind of riding down that weighted average lease term. We have our state government tenant that is there. It is still, it's an office. It has a state government tenant that takes up half the space. Their lease goes to 2029 as well. So we want to make sure that we're able to do something with this asset as we kind of look at that big renewal. But again, the business plan was not to turn things around, get them fully occupied with the highest wall, and then ride that all the way down and do that again, right? So that was not the original plan. And it looks like what we're doing now, we see Johnson Square, TVTC type deals, was we're going through that cycle twice. And that's what we're kind of preparing for and that's what we're gearing up for, because we do not want to be forced to have to sell something if there's not a whole lot of demand right there for it.
Yeah, and I mean, TVDC is a great example that, half the property is occupied by the state government. What attracts them to it, or the reason why we're there to begin with, is it has lots of gated parking. That's very unique. Chattanooga is very problematic when it comes to parking. It's mostly parking garages that are paid per car in the downtown area, and we have one of the unique properties that has gated parking that the government basically required for when they were looking for leases. So we feel confident I mean, if you go by the property, it's full of cars. They are actively using the space. We feel confident they'll continue to do so through this next cycle.
Yeah. So that's Johnson Square and TVTC. On the other front, in office, where we see that we're pretty bullish is leasing momentum that's done well. Now, we've had some tenants leave. So if we look at our Rate Bureau property, that was a 26,000 square foot single tenant government lease that ended up leaving. So what we then did was took that building and divided it into 3 suites, 2 on the first floor, 1 on the second floor. We've leased the bottom 2 suites now, and those have generated enough revenue to fully replace the revenue that the prior tenant was paying. So 50% occupancy replacing the full revenue that was there. Again, our business plan, it was never to really turn this one over. This deal was we were looking to buy this, do the lease renewal, realize that bump from the rate renewing, and then either assess the market time, hold it, or sell it. A lot of like what we do on the retail segment. With the tenant that left, that was obviously not in our plans, and we're now in a situation where, as a general partner, with loan money to that deal to be able to complete all the cycles of renewing stuff and leasing it, and then we'll look to exit that deal, once it's full.
Yep.
So. Again, not that what the business plan was, but we're making the best of it, and we are seeing leasing demand to do it.
Yeah, I mean, it's incredible that, in this relatively soft office market, that we had a government tenant paying basically half of what we're finding the on-market demand to be. And so, again, 50% of the building is paying the exact same amount or more than the government that was leasing the entire building. So the lender is going to be happy when we have all these leases, and we have one signed where we're finalizing the terms of the second one. The lender was just like, listen, we need to compare the debt coverage ratios before and after. We're like, well, we're in good shape with 50% occupancy. So the rest of the other 50% are really just all upside for us.
Yeah. So next one to look at is really the Lupton building, and that's one that is, again, it is a pure office. It's also in Chattanooga, and it's a deal where we have signed a few leases there. And we now have interest in basically a full floor for one user and another half floor to finish out the top floor of the building and lease all that space. And it puts us in a position where we'll be almost 50% occupied on really a full pure office. Now it's taken longer and it's more expensive than planned, obviously, so we're not excited about that part. However, we are seeing demand to do it.
Yeah, so this was a building that, 6 stories, has been vacant for a long time. On the market, it's been somewhat challenging to lease a vacant building and to show it. So we decided, like, hey, let's build out 1 floor. Let's take the risk and build out one. It's roughly 18% of the property. Let's build out 1 floor and show that off to the market and see what happens. And that build out really completed at the end of last year. And since we've been able to have that kind of showcase of the 1 floor, we're right on the verge of finalizing leases for 50% occupancy in like 6, 7, 8 months, which is pretty exciting on a building that's been very challenging. Again, we bought this property for $50 a foot. We put about $100 in to get the structure in a position to lease, and now we're basically doing TI build outs for each one of the floors, and everyone's a little bit different. Like sometimes they'll cost $100 a square foot for TI build out. Other ones, like we have a suite that they just take as is, and we've turned it a couple times, but It's just, it's about a 500 square foot suite that has no walls in it. And
Yeah, they're all different.
yeah,
But, you know, the core and the shell are all there, and now it's just
Yeah.
working on what TI package is needed to get someone in there.
right, exactly.
And the tenant we're working with that's gonna take the whole floor, like every floor has a kind of a common hallway, has bathrooms and a kitchen and a lounge area on every floor, so they're just gonna assume that whole space.
Yeah, so when we split the floor in half, we have two tenants, we normally can't capture the revenue for that common area space. But when someone takes the whole floor, we actually get to capture the revenue for the common area space as they're taking all of it. So it's actually a nice pickup. It's, you know, we have what, 15-20% loss to common
Yeah.
area in that building. And so for that specific floor, we're gonna pick up that extra 15-20%.
All right, so recap overall transaction status. Like we have 5 deals right now that we're taking out. They're all on the medical side. The office, we're really looking at leasing, maintaining, and holding those assets for right now. There's not a good exit opportunity with those in the market. So we're looking at holding those and maintaining where we're at. A lot of those, we're seeing revenue gains. We're seeing lease rates that are up, and we're also focused heavily on our leases and making sure that CAM is included in those, and we're seeing our CAM OpEx reimbursements continue to grow. That will be a huge part of success in 2025 as we look at our next 2 quarters we have for the year, is seeing what else we can pass through and work with on our CAM reimbursements. Okay, that concludes our update for the commercial segment. We're going to have a live Q&A this quarter. We have it every quarter. If you can tune in for that, we have the invite sent out for those as well. All of our distributions do go out on the 20th. And again, with those, we're looking at deals that we're looking to sell are not making distributions because we're in the sale process of those. But those all go out on the 20th, and you can see your property-specific investment reports in your investment portal. And lastly, we have our goal day on the 24th of the month here. And it's a great opportunity to recap how the quarter went and set some goals looking forward for the end of the year. We have speaker Eric Weir joining us this time, so we're very excited about doing that in person at our office here. Thanks for watching, everyone.